Hello and welcome to our January 2026 market update. My name is Doug Johnson. I am the senior investment strategist here at HCM Wealth Advisors. And as always, I'm joined by my colleague, Dan Rink. Dan, how are you?
Good, good. How are you?
Doing well. So let's go ahead and jump right into it here. So I'm sure over the next few days or weeks, I'm going to get asked a common question, which is, where do you think the market will end up in at the end of 2026? I do my best to avoid putting numbers on this, but let's see what this chart says. So, based on the fact that the beginning of the year started on a Thursday, it looks like the market's going to return about 17.4% through 2026. Uh, Obviously, that is a tongue-in-cheek comment, but this is a real chart that does actually take data from 1957 up to 2025 and runs the returns based on the day that the year started. So if you were taking this and using it, having the market start or having the year start on a Thursday is actually the best scenario. So going off that, I think we're in for a good year. But no, in all seriousness, I think from our perspective, we don't want to try to put or predict a number. It's just kind of a guess, and I think that you've probably seen the chart we've used before that shows strategist predictions of market levels based on different years and how wildly inconsistent and inaccurate they can be. So, we're not going to try to predict the future, but I'm going to give you some reasons today why we think 2026 could be another good year across the board, like we saw in 2025. So, Dan, why don't you go ahead and give us some more detail on maybe what we saw on the tail end of 2025 and kind of how the market looks under the surface right now.
Yeah, absolutely. So 2025 was a year that was kind of driven by the headlines all surrounding the AI boom. What I want to focus on is kind of the trading and market returns over the last 3 months. So this chart here goes back to October 2025, and it shows quite a few asset classes on here. It shows the S&P 500 in that purple line. It shows our growth indexes, shows our small indexes, shows our value indexes, and shows international. Um, so as you can see, pretty much across the board, you've had some pretty positive numbers. Um, Even though there was the big AI theme in 2025, towards the end of the year, the script flipped a little bit. So at the top of this chart, you actually have small caps, you have large value, and you have international, which is something that we didn't see for the whole entire year. And you're starting to see some of these names that were much maligned and, a lot of people deemed uninvestable that are starting to show some really strong outperformance. And then at the bottom of the chart here, you have the iShares Russell 1000 Growth ETF, and you have the Roundhill Magnificent 7 ETF. So for the last 3 months, starting back in October, all through Thanksgiving and the Santa Claus rally, you kind of saw those growth names really kind of lag, but the market still continued to chug on and really is starting to be driven by some of these asset classes that were a little unloved in 2025. Um, if you followed kind of the narrative that the market was extremely narrow and only driven by a handful of stocks, specifically in the AI space and in the large tech space, you'd kind of miss out on this chart. So this shows the last 12 months an equal weighted S&P 500. So every single piece of the S&P 500 gets the same weighting. It doesn't have that large tilt to large growth that the actual S&P 500 has. And if you look at it over the last 12 months, starting from April, it's been continuing to grind higher. And as we're, starting 2026, we're making new all-time highs. And again, that's the equal weight. That is showing that the market as a whole is pretty healthy. It's not continuing to be driven by those same 7, 8, 10 stocks. Um, so you're seeing a market that's showing a lot of health outside of those mega cap names that were pretty much all the headlines in 2025. Um, yeah, if you want to go here. So another,
I was ready to say, not to interrupt you, but I was ready to say, it feels like we've seen this happen before.
it feels like we've seen this happen before. So this chart here is one we've referenced quite a bit. This is the Russell 1000 value compared to the Russell 1000 growth. So when this line on the bottom chart here is going down, that means growth is outperforming value. When the line is going up, that means value is outperforming growth. So as you can see, this is a pretty long-term chart. Goes back to kind of early 2024 um, or 2023. Growth has been the driver of the market. As that line is going down, growth has just continued to push and push. We saw some fits and starts throughout this whole time period where value would start outperforming, but it seemed like it kept continuing to go back to that growth theme. And then if you look at the very far bottom right of this chart, starting in November, you're seeing value start to pick up again. Um, so if you're a value investor, you want this trend to really continue and turn around and really start pushing up. If you're a growth investor, you're looking for a mean reversion for this to continue heading down to the right. But again, we're seeing some really productive trading that shows you that value may be actually putting in some strong footing here, but if we look at history, we know we have to be patient and really see if these trends do end up changing direction or, flipping back to status quo.
And I think if we took this chart out even further, I mean, this is, I think,
Yes.
is a 3 year chart. If we took this to like 10 years, it would not change much at all. I mean, maybe
Not
you'd
at all.
see in 2022 the line moving up, but this trend has been established for a long time, with growth being the dominant factor over value.
Yeah, absolutely. And then this chart here kind of continues to piggyback on that story that the rest of the market is continuing to be strong. So this shows the Magnificent Seven, so those largest growth tech names in the S&P 500 versus the S&P 500 as a whole. If this line's going up, that means the Magnificent Seven is outperforming by itself. If the line's going down, that means the S&P 500 is outperforming. So as you can see, about again, October of 2025, you really started seeing the Mag 7 lag the overall index. And if you're looking at the S&P 500 today, you're at all-time highs. There's a lot of people that would say, "Hey, you can't have all-time highs unless you have the Mag 7 making all-time highs." Well, this just speaks to kind of the strength of the overall market. Despite these biggest names, these highest concentration names outperforming the overall benchmark, the benchmark is continuing to roll up and hit new all-time highs. I mean, we hit S&P 7,000 this week. So we we have this narrative that you have the smallest stocks or the a small section of the S&P 500, the biggest stocks that are really driving everything. And we're seeing a lot of evidence that despite them starting to underperform, the S&P 500 is continuing to roll. And another chart that, a lot of people don't focus on because it's been an asset class that has been very difficult for a long time. We have U.S. microcaps, U.S. small caps, and U.S. mid caps. These are asset classes that show a little bit more risk behavior. Microcaps probably the most risk on the left, and mid caps a little bit better on a risk adjusted basis on the right. They're making all-time highs. This goes back from, April all through today. And if you are looking at a market and trying to gauge the risk appetite, investors are fully risk on at this point. Um, you do not see micro caps, small caps, and mid caps making all-time highs if the market is unhealthy. So you're seeing that yes, we're pushing new all-time highs, but all the other sectors that should be confirming this rally are. So Yeah, I mean it's showing that there's a very heavy risk appetite and it's being rewarded.
Yeah. So you wouldn't say this is bearish.
No, you would not say this is bearish. And then AI. So one of the main ideas behind AI is that it's going to really increase productivity, which is good for the economy, is good for businesses. This is a survey basically saying over the last 12 months, how has your firm's use of AI affected the following outcomes of your firms? So the four sections here are labor productivity, decision-making speed or accuracy, customer satisfaction or retention, and time spent on high value add tasks. Um, so as you can see, the largest majority of the answers are kind of no real change, or I'm unsure because it's kind of hard to quantify. But you're starting to see respondents saying we're increasing productivity and customer satisfaction by 1 to 5%. And then you're even seeing firms saying we're increasing this by more than 5%. And I think as people start using AI and become more productive with AI, these numbers are going to shift even more to the right, further increasing productivity, hopefully, and further increasing, you know, value added processes of business that will continue to help not only small companies, but large companies become way more efficient and um, could be a very interesting next 5 to 10 years. And then, we touched briefly on breadth. This is a breadth chart I think we referenced either in the last webinar or maybe two webinars ago.
Yeah, well, I think we did the
Um,
last one.
yeah, so this is the NYSE advanced decline. Against how many stocks are advancing, how many versus how many stocks are declining. You know, there were, I think when we last did it, there was a little bit of a chop there that we were looking at. But we have since just resolved even higher to the right. So, in markets with strong breadth, it really rewards you to own equities. And if equities are showing signs of weakness, it'll show up here first. As this continues to push, it just shows that the equity markets are really strong, not only from a price perspective, but under the surface, things look still very, very good.
Yeah, I feel like it was just yesterday when this chart was all over the place because everyone is
Yes.
concerned about this
Yep.
here,
hmm
talking about, oh, breath's breaking down. Here we go. And then sure enough, we are well clear of all time high in
Breath
that
doesn't break until it breaks.
regard.
And this is another visualization of the S&P 500 breadth. We've referenced this chart before, not probably not recently though, but this shows the percentage of S&P 500 stocks above their 200-day moving average, above their 50-day moving average, and then both above both averages. Um, so the 50-day, 200-day moving averages are usually pretty strong trend signals. If an index or a stock is above both of those, it usually means that there's a strong upward trend. Um, this is a great visualization. On the far right, you can see that green bar that shows the S&P 500 both over the 50-day and 200-day moving average continuing to increase. That's what you want to see. So it's saying, I guess, 53% of the S&P 500 are over their 50-day moving average and 200-day moving average. The numbers that I reference are slightly higher than that. So yeah, we're from a breadth perspective, it's not only good, but it's continuing to get better. Again, these things can change quickly, but if we are looking at the market as a whole and looking at everything under the surface, um, it looks pretty productive. And again, more confirmation of kind of the risk appetite of investors at this point. This shows the small cap consumer staples versus the Russell 2000, and it shows the large cap consumer staples versus the S&P 500. Now, your consumer staples, a lot of people think Procter and Gamble. It's your more defensive names. It's stocks that people buy if they think the economy is in trouble. Hey, people are always going to need to buy, you know, laundry detergent, that kind of thing. Um, if we look at this ratio, there is no appetite for those risk off names. Usually, when you start to see some turmoil, some worries about the economy under the surface, you'll see these areas start to attract assets. But at this point, in the large cap space, the S&P 500, and even in the small cap space, there is no appetite for these defensive names. Everyone wants to, own the stocks that are working and continuing in the hopes that this economy continues to keep rolling through 2026.
Yeah, so we talked a lot about kind of where the market is right now, and I think the overwhelming message from a kind of trend or technical perspective is that there's not a lot to not like right now in this market. I mean, we have seen these rotations in the past, but rotation and broadening is the sign of a healthy market. And I think that the people have been waiting for this type of market to set in, and we've seen some false signals in the past, but here we're trying again, and I think not only from a technical perspective, but I think from a fundamental perspective, there's a lot to like as well, and we'll look at kind of what those factors are, for 2026 and how we kind of see them playing out. So one of the biggest drivers of stocks over the long term and maybe even the short term is earnings. Ultimately, if earnings are going up, that is a good sign for equities. So this chart simply shows the earnings forecast for both 2026 on the right side and then 2027 on the left side. And you can clearly see that the blue line for 2026 and the black line for 2027 are both moving in the correct direction and are expected to grow either we'll call it low double digit or high single digits for the next 2 years. So there has been some concern about valuations. I think that if this type of earnings growth is projected, you could see a market that kind of, I think the saying is like growing into the valuation, because there has also been some concern that, valuation or not margin expansion, but, price or PE expansion has taken us as far as it can. And then now we need to, follow through with the earnings, but everything that we've seen on a projection basis looks really, really good. And then, has there or will there be a shift in the makeup of earnings as it relates to the Mag 7 and the S&P 500? So going back to 2023, you can see that the Mag 7, I mean, even 24, the Mag 7 had a bulk of the earnings growth, while the rest of the S&P 500 did not. That looked a little bit different last year, and that gap is supposed to continue to narrow going into 2026. So some of this value small cap, we can even say international rotation, could be attributable to this scenario playing out where we're finally starting to see earnings growth and earnings generation even as a percentage of the S&P 500 overall, starting to come from some non-Mag 7 areas of the market, which overall I think would be a good thing. And in addition to earnings, profit margins are an important part of that. Higher your margins, the easier it's going to be to generate solid earnings. And as we look, margins continue to expand. I mean, they've expanded ever since kind of the COVID bottom back in 2020. We had a small dip again in 2022, but since then we're back to margins that are at all-time highs. And I think as long as we're trending in that direction from the margin side, that's a positive for businesses overall. It's a positive for earnings, and ultimately it's a positive for stock prices going forward. Now, outside of we'll call it microeconomic area, what is the macroeconomic area telling us? So this is the Atlanta Fed's GDP Now projection for what would be Q4 in 2025. And we've shown this chart a few times, and I really can't remember a time where we've seen a gap this wide between what the Atlanta Fed has and what the blue chip consensus is. So the Atlanta Fed, as of last week, is projecting that GDP growth, real GDP growth in the 2025 fourth quarter is going to be 5%. That is a massive number. And then the blue chip consensus. Now, granted, this doesn't go out as far, or it kind of ends December. We'll call it 5th, I guess. I'm not sure why this is not projected out, but the range from the bottom 10 and the top 10 forecasts from Wall Street is anywhere between, we'll call it right at 0 or a little bit below that to right below 2. So I'm not quite sure what's causing such a divergence in the projections here. I mean, 5% would be a really big growth number on the GDP basis. Even if we hit the average of right below 1%, which still is technically not in recession territory, I think there'd be a little bit more concern that the growth was slowing down. But this, again, is a projection that economic growth is continuing to, at worst, maintain, and at best, continue to expand. And there was some real concern about this in the face of tariffs last year. I mean, I think there was a lot of concern about it being inflationary. There was going to be a headwind to the economy and all these things. So far, that has not played out. I understand we have a ruling on tariffs that's supposed to be coming any minute now, but so far that has not been a deterrent to either the market or the economy going forward. We just mentioned inflation. There was a print recently. Inflation remains under control. Still not below that 2 or 2.5% range that I think the Fed would like to see it at, but it's also not in the 3.5, 4 range that I think people would be concerned about going forward. And I don't know why this line is not connecting to this dot, but this is the most recent CPI reading, and I believe it was 2.7%. There's a lot of different versions of CPI now. There's core CPI, there's X, whatever they want to exclude, but I think the all items number is right around 2%, and I think the Fed would gladly take that number going forward. So as it relates to inflation, how is that going to affect rates? So we've had, I guess you could call it the beginning of a rate cut cycle last year. And there's expectation that will continue into this year. The question is by how much? So we've got 3 different time periods represented here. We've got the blue line, which was the implied Fed funds target, or basically the prediction of the target, in June of 2026, September 2026, and then December of 2026. And then the bottom represents the timeframes that those forecasts were given. So, for example, back in September of 2025, you had June expectations of rates at 3.15. September was going to be right around 3, and then in December it was going to be between 2.9 and 2.85. So the Fed would never cut 10 basis points in a meeting. So you have to remember those are averaged out. But what's interesting about this is as we've moved forward, these numbers have crept up a little bit. Whereas you have all the expectations a little bit higher. I mean, if you look at the absolute numbers, it really only comes out to about 1 cut that's being kind of phased out. I know there's been some headlines recently about the president and the Fed chair, having a little bit of a squabble. And I don't know that that's materially changed the forecast, but nonetheless, I think the super aggressive rate cutting cycle that we may have been expecting has mitigated a little bit and maybe reversed slightly. But again, the market doesn't seem bothered by this. And when I say the market, I mean both equities and the bond market. 10-year rates have have stayed pretty well under control. So I think from a Fed standpoint, the expectation still is for a cut or two this year. But that is a ever changing forecast. And I think, inflation probably has the biggest, we'll call it impact on what those forecasts looks like outside the labor market. But right now, those seem to be pretty much under control. And then fixed income. After 2020, a lot of people swore off fixed income forever. I don't blame them. If you look at this chart, though, I think you can realize that 2022 was an extreme outlier in the return department. And last year was actually the best bond performance year since 2020. So you had the Barclays Ag, which is just really the S&P 500 for bonds, up a little bit over 7%. And then even if you take the 2 years prior to that, in 2023, you had roughly 6%. And then in 2024, I think it was closer to 1.5%. But the point being, you had positive bond performance each of the past 3 years. And if you look at this on a longer term basis, there's very few years in the fixed income market that we've seen that's had negative years. Now, I understand the rate dynamics in this time period is very different than the rate dynamics that we're in right now. But we don't want clients to completely shun away from fixed income or even non-equities because that is and will remain an important diversifier in any portfolio. So let's look at a few macro scenarios. This shows since 1980 kind of a scenario analysis of both what the Fed funds rate is doing and then what real GDP growth is doing and how that affected the kind of 12-month change in the S&P 500 PE since 1980. All right. So we've had some, we'll call it expansion in that area there is some concern that it maybe has reached its peak. But if we look at these scenarios, kind of tells a different story here. So the two that are, or I guess four that are highlighted here would be when the Fed funds rate is either being cut or is stable, which I think we can agree is the scenario that we're looking at right now, compared with US real GDP growth, which is stable or accelerating. And I think the chart that we saw earlier would also agree with that. So in those scenarios, since 1980, that has led to S&P 500 valuations expanding in all scenarios. And when you had a cutting Fed and an accelerating growth scenario, or a cutting Fed and a stable growth scenario, it's expanded by a decent clip. So while we talk about valuation expansion being off the table, I wouldn't completely rule it out. And if you get the tailwind of earnings and valuation expansion, that is the kind of Goldilocks scenario for markets to surprise on the upside for sure. So I think those things are lining up to be beneficial. Obviously, if you get into the hiking or contracting area, then you're looking at a much different scenario, but we don't seem to be in that environment right now. And I wouldn't say that there's a strong forecast or reason to believe that that is imminent based on what we see. Now we've shown a lot of positive charts. I know we showed this chart last time. And
Say we sound like perma bulls, Doug.
We do. And it's not the worst thing in the world. As long as the market's going up. But we've also shown that if things change, that we will also change our strategy. So, but yeah, this is one chart that I, continue to see and kind of scratch my head at. So this is just a comparison of the leading economic indicators in the US against the coincident economic indicators in the US. And the takeaway from this chart, if you look at the gray vertical bars, those represent recessions. And in all of those scenarios, you've had the blue line, which is leading economic indicators, cross below the coincident economic indicators. We saw it in 2001, we saw it in 2007, we saw it a little bit in COVID, but now we've got this really, really wide gap. We've had this really wide gap for, we'll call
Years.
it 2.5 years, maybe, and still no recession. Not even really the whiff of a recession. So I've thought long and hard about what could be causing this. Um, and as I look through kind of the factors that are involved in these indexes, and again, I'm going to say this, and I'm going to say it as objectively as I can. There is a lot of survey data in this, and I think with the current political climate that we are in, the survey data has become so skewed and so black and white that if you are in support of one party, you are going to respond in a way that you're not even going to consider any other data, but that's the way that you're going to respond. And if you believe in the other side, that's how you're going to respond. So the only interpretation I can give for this is that there's been some distortion in some of those surveys. And we've actually seen it play out. I mean, now you can break down, I think, survey responses by political party. And I don't have those in this deck, but I've seen a few of them, and they are incredibly skewed. The gaps are just incredibly wide. So maybe that has something to do with this. But if we were looking at past instances where recessions have occurred, this is usually an indicator that does a good job of showing that. But for whatever reason, that's not playing out right now. So let's look outside of the U.S. because we had a good year for international last year, the first in the past 15
Yeah.
as it relates to the U.S. And it seems like international is continuing to perform well. At the start of this year, so we've looked at kind of the leading economic indicators in the U.S. How does that look on a global basis? So this shows the G20, and it's pretty positive. You've got above what would be considered baseline at 100, and you have this line trending higher. So I think it maybe isn't just a US story right now. You could make the case that it's a global story right now in terms of economic growth. So we always like to end these with some perspective charts. So this was an interesting one that I found regarding the AI investment boom, because there's been a lot of headlines about this recently. And really, it's more or less a concern about the fact that people feel like this AI trade can't continue because there's been an overinvestment, that at some point it has to fall apart. This chart would argue the opposite. Now, this shows the change in investment as a percentage of GDP. So again, there's different ways to kind of skew this data, but this is a perspective that I hadn't seen before, and it compares it to some other kind of boom periods in the past. So you've got blue bar is the Australian mining situation in the 2000s, which isn't really a popular bubble, I guess you could say. Japanese commercial property in the 80s, you have oil in the 70s, you have tech in the 90s, Canadian oil in the 2000s, US oil in the 2000s, USAI in the 2020s, and then what the average would be. Now, sometimes you got to be careful with the averages, because if you have your foot, I think what it is they say, if you have your foot in an ice bucket and your foot in a pot of boiling water, the middle is average, but you're going to be uncomfortable. So obviously some of these bigger bars are going to skew this average higher. But I think the point is that if you look at the AI investment boom as a percentage of GDP, it's not as massive a number as we've seen in some of these other instances. So, Dan showed that chart earlier with the AI themes. I think we've had a very narrow view of what the AI expansion can look like, and it's been limited to just kind of the tech space, but now we're starting to see the energy space participate in this. And then I think the last step is you do get a productivity boom that could trickle down to all areas of the economy, and that could be another driver to help value recover a little bit. We didn't really have the traditional Santa Claus rally last year. but that's not really an issue based on what we've seen. So back to 1967, here's 6 instances where there was no Santa Claus rally, but the first 5 days of the next year were positive. What does that end up looking like for the rest of the S&P in terms of the calendar year? Pretty good. I mean, 94 in 2015 kind of had flat years, but 67, 80, 25 all had some pretty healthy numbers. So no Santa Claus, no problem. Good start to the year is usually a positive. And then lastly, a lot of people ask, how long can this last? Well, it can last a lot longer than you think. So the bull market, if we use October as the starting date, which I think is fair, that was the beginning of the recent run, and it was after we had a technical bear market in the S&P and even in the Nasdaq. The S&P change since then has been roughly 93%, and we've had about 3 years. So if we compare that to the most recent bull markets going back all the way to 1950, we're still not even at half of the return of the average bull market. We're not even at the median of those. And you are a little bit past halfway using the average and a little bit more past halfway in the median. So if your investment thesis is this rally has to fall apart because it's been going on too long, you need to rethink that strategy, because the data would tell you that we are probably closer to the middle of this than we are to the end of it. Now, obviously, things can happen, but if your only line of thinking was that this just can't continue to go on, well, yes, it actually can. It usually doesn't go on in a straight line. There's periods of volatility. I mean, we saw that last year in April. That technically didn't end this bull market. It was very short-lived, but I think it's fair to expect volatility as we move throughout the year, and volatility is the norm. So, we're optimistic that this run can continue for all the reasons that we laid out in this slide deck. But just as a reminder, we have a plan in place to react and adjust portfolios accordingly. If this does start to run into, if the market does start to run into some headwinds, and we see a little bit more risk off trading action. So that's all we have for today. Our goal going forward is to have these once a month, at least until the summer months. So you can expect another one in February. If we run into some very volatile trading, we may do something off schedule. And then I guess I also want to plug a new medium of communication we're going to have. Dan and I are going to start broadcasting a podcast here over the next few weeks. It will be strictly market related. It may be a little bit more informal or more conversational than what we do in these. But we surveyed clients, and the consensus was that more investment communication is better than less. So we're going to give this a shot and see how it goes. So we certainly would welcome your feedback on that. If you get a chance to listen, let us know what we're doing well. Let us know what you'd like to see us do better. And we'll certainly take that into consideration. But until next time, thanks for joining us, and we'll see you later.